QuickBooks Pro Desktop 2021, Tax Line Mapping, Adjusting Entry, Depreciation Overview. Let's get into it with Intuit, QuickBooks Pro Desktop 2021. Here we are in our S-Corp test file. We currently have the open windows open. You can open the open windows by going to the View dropdown, selecting the open windows list. In prior presentations, we did the mapping for the chart of accounts, and we entered the data into the system that we then exported to Lacerte tax software owned by Intuit, the same owners of QuickBooks, and exported to Excel so we can do a reconciliation process as well. So if we go to the reports dropdown and the company and financial, we can take a look at the profit and loss currently here for the date range 01/01/19 to 12/31/19. We have the 100,000. We exported that to the tax software. Tax software now showing on the tax side 112,500, and we exported to Excel and put together our Excel worksheet where we can see the 100,000 here. We want to reconcile between that 100,000 and what's in the tax software and make any adjustments that need to be made. Now, one area that's often a problem is related to the property, plant, and equipment, because we have the depreciation and the accumulated depreciation that we need to enter. Couple problems here. One, you might have a difference between the book value and the tax value. And two, whatever you put into the system on this side, on QuickBooks side, that you then import into the tax software, if it was just to take that number, it would be overriding what's in the tax software. In other words, if I go back to the tax software and it was, if it just took this number and populated it right there from QuickBooks, then it may not tie into the tax depreciation schedules, which were typically generated from the tax software. So in other words, in order to know what the depreciation is, generally you need the tax software to do it, at least on a tax basis and oftentimes on a book basis as well. So what we'll do here is we'll actually set up the depreciation in the system, let the depreciation then calculate out here. And then this is always going to be kind of an issue that you'll have to be double checking, because when it imports from QuickBooks, it can't just overwrite. You want the information to come from the tax software, so it ties out to the tax schedules. So let's put some information into the tax schedule here just to experiment with this. We're going to put the whole thing in there as one piece of equipment, and I'm going to say that it's going to go in there on as of last year, the prior year. So we have this prior depreciation that's currently on the books. So this prior depreciation should roll over from the prior year. So I'm going to say the 100,000 from the prior year, and then prior year depreciation or amortization, I'm going to say is this 19,592. So it's going to be the 19,592. And so there we have the prior year information. If I go to the forms then and check this out, and we take a look at the depreciation schedules for 2019. So now we have the prior depreciation. Now it has prior 179. Let's go to the regular item here. So there's the prior depreciation, and it's not calculating the current depreciation. Let's go back on over. I need to have a method here. That might be useful. So 179 method. So I'm going to say this is a 7-year property, 7-year makers. That looks good. Let's check it out again. So now it's calculating prior year at that 19,592, and then in the current year, if I scroll up to the tax return now, it should then be populating here on this line, and that's pulling from the depreciation schedule. So that needs to basically link together, at least from the tax basis purposes. Now we also might have an issue where there's a difference between the book and tax depreciation. This may not always be the case because they might just be using a tax depreciation, but if it is, then you can typically calculate that in the software. You can in Lacerte at least. So, but you have to go down here and tell it, hey, I want you to do something different for the book side of things, so I can have the book depreciation. So I'm going to say here, we'll just use a straight line method, straight line, and I'm going to call it 7 years, 7-year property, but we're not using makers, which is a form of double declining balance with a half-year convention, but rather just simply straight line method. So I'm going to go back on up and see now, if I go to the 2019 depreciation schedules, regular depreciation, I've got the 100,000, and then the priors at that 19,592. And if I go to the book schedules here, the book schedules Then I've got the prior depreciation we set at that 19,592 because we set that, we basically input that in directly. And then the current depreciation is different now, the 14,286. So now we're at the 14,286 for the book side of things, which is going to differ from the tax side of things. So that can be a bit of a complication. We'll actually make it a little bit different than that even. I'm going to put the prior year depreciation on the book side at the 19,592, and then the prior year book tax depreciation at the 25,000. So if we then look at that comparison, and this is going to be typical if you have like a difference between the book and tax, if you're recording a different depreciation for book and tax. Then on the tax side of things, we have a difference in the prior year and, of course, the current year amounts that we have to basically make adjusting entries for. So in this case, we had 25,000 the prior year for tax, 24,490 for the book. And then if I go to the book side of things, then in the prior year, we had that 19,592. And on the current year, we got that 14,286. So we're going to have to make adjustments for those items, and we'll take a look at that in future presentations.